Hello, everybody. Ed Yardeni here. It's December 8th. It's Monday, 11 a.m. in Long Island, and everything is nice and peaceful here. We've got a nice sunny day, but it's rather cold. The peaceful nature of the day is marked by the visit of Max. Max has decided to join us this time around, and he seems particularly peaceful when you see him in the background there. So we'll see how long he stays up for us. I screwed up last week. I had a call on Tuesday with Nick Raish, and Nick is the CEO of Earnings Scout. I've known him for many, many years, and he does a really good job on analyzing earnings. But I forgot to press the button. I forgot to press the record, so there wasn't a record. But those of you who tuned in live got to see the show. Those of you who were not able to see it and try to replay it, I apologize for that. But Nick and I discussed a bunch of things, but my interest and my focus with him was to discuss the quality of earnings, especially with the hyperscalers. And just to summarize his point of view, he said that on a scale of 1 to 10, where 10 is outright earnings fraud, and 1 is pristine earnings, he said that the problems with the hyperscalers and the way they're depreciating chips and things like that, he said it's more like 2 to 3 than it's anything close to 10. So that was reassuring, certainly. Lots to talk about. I did a couple of things over the weekend, sent a couple of morning briefings and a quick takes in which we kind of increasingly are focusing on 2026. 2026 is coming, and we have to think about whether, how it might be different from 2025, and whether it still is likely to be consistent with the roaring 2020 scenario. And so we are feeling actually a little bit more optimistic about the roaring 2020 scenario because we're less concerned about a melt-up, melt-down scenario. I think that with some of the recent developments, particularly with the hyperscalers with regards to the so-called AI bubble, I think the fact that so many people have been worrying about an AI bubble, that's from a contrarian perspective, that's a good thing. In the late 1990s, you'll have to refresh my memory, but I don't recall too many, if any, people really getting all upset about a bubble in dot-coms, a bubble in the internet. I recall actually that I was in Boston in late 1999, and there was a fellow at one of the accounts, one of the big mutual fund accounts, and he was absolutely passionate about how insane the market was, and he said that Cisco was a complete, that the earnings weren't legit. And anyways, he was ranting and raving. Anyways, he lost his job because he missed it all. And of course, a few months after he lost his job, turned out that he was absolutely right. And Cisco took a dive, and we had the tech wreck following the tech bubble. This time around, we certainly have Michael Burry to thank for reminding us that sometimes we can get into a bubble with the quality of earnings being questionable. And he certainly raised a lot of issues. And I think we've also seen that the competitive landscape is changing very rapidly in technology, particularly for the hyperscalers. For a while there, it looked like the center of the AI world was OpenAI, and that they were doing all sorts of deals with NVIDIA and SoftBank and other AI companies. And everybody kept asking the question, how could AI actually afford all these commitments. And then out of the blue, Google announced Gemini 3 and made us realize that this is a very dynamic process and things can change very rapidly. And it may be a very long horse race. It may be a horse race with no ending, that there may be a leader for a while and then another leader, then another leader. I guess we could use the not only a horse race, but also leapfrogging, frogs leaping over one another would be another analogy. But just as the Google Gemini 3 news came out from DeepSeek. Remember DeepSeek? That's the company that caused the correction in the AI stocks and the hyperscaler stocks at the beginning of the year. DeepSeek announced in January or late January of this year that they had come up with a LLM, a large language model, that they had trained on chips that were much cheaper than NVIDIA's chips and didn't cost as much to put together. And apparently it was a pretty good model. But in the first and second quarter earnings season, the big AI companies said that nothing had changed as far as they were concerned. DeepSeek didn't change their minds, that they needed to create huge data centers, buy lots of NVIDIA chips in order to train their LLM models. And made me a little bit nervous when Sam Altman started saying that the reason we have to do this is because we need to cure cancer. And so, basically his notion was we have to spend trillions of dollars on data centers, because if we don't, it's a shame, because we can solve so many of our problems if we only had the AI resources to do all of this computing. So again, DeepSeek came along once again just about a week ago and said that they've got a new version of their LLM, and by some metrics, apparently it's just as good as Gemini 3. So there's a lot of competition going on here. It's kind of like Game of Thrones, at the beginning, at the opening credits, where the towers go up and down. These kingdoms of the AI are battling each other. Sometimes they're cooperating, sometimes they're forming alliances, but the competition is increasing. Look, historically, anytime you've got a sector that's got an amazing profit margin, anytime you have an industry, anytime you have a company with an amazing profit margin, you're going to have wannabe competitors. And in this world, raising money is not really an obstacle. It's not a barrier to entry, not in technology. And I have one of my neighbors here in Long Island. He's on my friend's reading list, and he said, that he's made some money in these AI stocks, that he's always been investing in sort of state-of-the-art, leading-edge technologies. And right now he said he's involved in a company that might be able to do what the hyperscalers are doing with a lot smaller scale, without these huge data centers and so on and so forth. So we have to anticipate that there's going to be innovations. There's going to be a lot of changes going on. And so I looked at we know that the Magnificent Seven account for something like 70% of the market cap. Sorry, let's do that again. The Magnificent Seven account for 30%, roughly, of the market cap of the S&P 500. And there's been a lot of concerns about concentration. And now I think we need to consider the possibility that if there's going to be more competition among these Magnificent Seven, that the beneficiaries are going to be their customers. And so it's the impressive 493 that will be benefiting from this competition. Now, when we look at information technology and communication services together, we see that the market cap of those two sectors in the S&P 500 is up to 45%, all-time record high, 45%. So almost half of the S&P 500, 45% to be exact, of the S&P 500 market cap is attributable to information technology and communication services. I've been recommending overweighting these sectors for quite some time. I think even starting back in 2010, information technology was and communication services were among our picks for overweights. We started, I think, pounding the table on that maybe more like 2015 when they really did in fact start taking off. But maybe it's time to consider the possibility that 45% of the market cap of the S&P 500 is as good as it gets. Now, admittedly, the earnings share has also gone up to about 38%. Back in the days, back in 1999, during that bubble, I think we had the sum of communication services and information technology market cap also going up to about 45%. We're a little bit higher than that now. But back then, the earning share was 25%. Now we're 38%. So there's actually more substance, earning substance to the increase in the. You okay, Max? Maybe Max had a bad dream. So that looks like there's more substance. But on the other hand, it's hard to imagine that it's going to be 50, 60, 70% of the market cap of the S&P 500. And so I think we are going to start to see this competition benefit the impressive 493. And the 493 have, in fact, seen their earnings going up. They also are at a record high. They just haven't increased by as much as the hyperscalers, the Magnificent Seven. And then to the extent that now there's maybe some more questioning, I don't know, maybe even doubting of the quality of the earnings that are being reported, or at least there's a debate, let's put it that way. I don't really have a problem with the way these earnings are being reported, and I think these companies really are great companies. But it's time to consider the possibility that finally the market is going to broaden out. The same holds with regards to thinking about stay home versus go global. We've been recommending stay home, overweight the U.S. Since 2010. It's worked out great. And but now this year was not such a great year for stay home. Go global did better. And not much better if you did it in currencies, in local currencies. But if you do it with the dollar, obviously the dollar also made the return of foreign markets better than the U.S. But maybe there is something more permanent going on here that makes the rest of the world look like not a bad place to invest or to find opportunities. I'm sure some of you have already been doing that for the past year, and it's worked out in some unusual places. I mean, Spain's not that unusual, but it's been one of the big outperformers. China's been a big outperformer. What's really unusual is you would think it was technology, but it's actually healthcare in China that's been a big outperformer. We've, on the other hand, seen that India has been a very weak performer this year on a relative basis. The United States is up about 16% when you look at the MSCI indexes. The all-country world, excluding the U.S., is up about 19% in local currency. But again, you add the weaker dollar that we've had so far this year, and you get a better return between the currency and the outperformance of the MSCI. But, you know, it's a big world out there. It's amazing how well the global economy has been holding up in the face of the tariff issues that were raised by the Trump administration. We've certainly seen reshoring here into the United States, but we're also seeing the reconfiguring of trade flows on a global basis. China's trade with us continues to decline, to diminish. But on the other hand, China's doing quite well in offsetting that by expanding their trading relationships with other countries, particularly emerging countries. And maybe that kind of dynamism is creating more economic growth or more resilient global economic growth. At some point, China may get some pushback from other countries that are starting to realize that they're doing to them what they've been doing to the United States, which is basically dumping products subsidized by the government at low prices and creating markets for themselves with unfair competition. But for now, the reality is the global economy is hanging in there quite well. But look, the U.S. now accounts for 65% of the market cap of the world, all-country world MSCI, 65%. And again, the earnings story partly gives that some support. We're up 55%, up to 55% of the earnings share of the MSCI is accounted for by the U.S. But 65%, I mean, I guess what I'm saying is that it's hard to recommend overweighting the United States in a global portfolio when it's already 65% of that portfolio. You're already basically overweighting it if you just kind of maintain a neutral stance relative to the actual benchmark. Same thing is kind of motivating me to rethink the idea of overweighting information technology and communications services. You don't need me to tell you that. The market has already done that with 45% of the market cap of the S&P 500 being in these two. And oh, by the way, as you all know, since you're all managed portfolios, managed money has to have some balance. You can't put all your eggs in one basket, as they say. A passive account can obviously reflect the fact that 30% of the S&P 500 is 7 stocks. But most professional money managers and even individual money managers still believe in some diversification. I guess if you want to be a multi-billionaire, then you have to do what people like Soros and Druckenmiller and Cooperman and others have done, and that is come up with one or two ideas that you are absolutely convinced are slam dunks, and then put all your dough in there, and then you get really rich and keep that kind of approach. But that's a tough one to succeed in. That's why we don't have too many people that are actually doing that. And most money is managed on a diversified basis, and having more than 2 to 3 or 4 or 5% of one stock in a portfolio is kind of gamey. So if I just told you to market weight the United States, you're still overweight to the extent of 65%. If we just said let's just market weight information technology and communication services, it's the same story. So the bottom line is I would market weight information technology and communication services. I would continue to overweight financials and communication services. Financials and industrials. Would add healthcare into the mix here. I know there's issues with the administration and politics of pricing, but the healthcare industry is actually the biggest industry we have in America. We keep talking about technologies as being sort of the growth area of the economy, but healthcare is a huge part of the economy, and its earnings have been increasing. It's been unloved, and so I think there's something to be said for healthcare. With regards to the United States, emerging markets will probably continue to deliver some outperformance. So diversifying globally, which I'm sure many of you have already done. You don't need me to tell you what to do. You know what to do. And you've probably been ahead of me on this. But I would say go for some emerging markets maybe even Europe, maybe even Japan. But all in all, there are opportunities, obviously, in the global economy, and I'm willing to concede that point. What else? Well, let's talk about what could go right, what could go wrong in 2026. That's the morning briefing. Speaking of what could go wrong, I try to get my charts to work, but for some reason it just doesn't want to do it. One of these days I'll get it right. Okay, this is real live video. Let's talk about what could go right in. I made myself a little list so I'd remember here. The midterm elections are coming, and we recently started to show some charts that ever since Mamdani was elected to be the next mayor in New York City, and after the November elections that also did not go well for the Republicans in Virginia and a couple of other places, that the Republicans have started to realize they've got a problem when it comes to the midterms, and that the issue that they really need to scramble and address is affordability. So the Trump administration is clearly going to do whatever they can to convince consumers that they are on the right track to bring prices down in some areas. They've been working on that in healthcare. Now they're thinking about bringing in some more beef from places like Argentina. They're kind of being forced to back off on some of their tariffs. But meanwhile, what's really stimulative for next year, which they've kind of already baked into the cake, is the OBBBA, the big beautiful bill act that was passed last year, and it was passed with tax cuts retroactive to the beginning of this year. I'm sorry, that bill was passed this year, and it was retroactive to the beginning of the year, and as a result of that, the spending, the tax cuts that were implemented this year will lead to large rebates in the tax reporting season up ahead here in 2026. So there's going to be a lot of fiscal stimulus coming into the economy. That may get the bond vigilantes upset because the deficit is bound to increase as the government has to fund these things. There's also the question of a Supreme Court ruling possibly against the tariffs, in which case the administration will also need to either get the money or scramble to come up with an alternative tariff regime, which they claim they have. In the what can go right camp, we continue to argue that the baby boomers are retiring, continuing to retire, and that they're sitting on $80 trillion of net worth, and they'll spend that. The Fed easing, the Milton Friedman said that the Fed has a long and variable lag impact on the economy. Well, Fed easing, the 175 basis point cut in the Fed funds rate over the past year will probably provide some stimulus going into next year. The Fed on December 1st terminated quantitative tightening, so that provides some liquidity perhaps. And then technology capital spending, companies are committing to quite a bit of capital spending this year. And once you start a data center, it's very unlikely that you're just going to suddenly stop it. And then, of course, there's onshoring, and the administration claims on their website trillions of dollars of commitments. Whether those commitments are realized or not is a question, but it's a lot of money, and some of it will show up in the economy next year. Now, what could go wrong? Let's start out with my friends the bond vigilantes. Apparently, my wife and I were planning on going to Japan, but changed our plans this summer for harmless reasons. So everybody seems to be going to Japan. So the bond vigilantes went to Japan. Maybe they went on vacation, and then they started looking around and started to realize that there's a debt crisis over there. And we've seen bond yields absolutely soar as the new government is intent on stimulating the economy. And that suddenly the Bank of Japan is being viewed as likely to turn hawkish rather than dovish. So the bond vigilantes are working over in Japan. They could be working here. I mean, even this morning, I see that the bond yield has continued to go up. I guess it's getting closer to 4.20, which isn't what it's supposed to do when the Fed's lowering interest rates. But these Fed folks, they just won't listen to me. Last year, I warned that if they eased, they were easing into an economy that was actually resilient, didn't really need them to ease. But they did it anyways. They said that the Fed funds rate is restrictive. It's too high relative to the neutral rate. They said the neutral rate is 3%. When you ask them, well, how do you know that? They said, well, that's an average of our opinions. And so, at 5%, we're too restrictive, so we have to lower it closer to 3%. And I said, well, that's fine, but the bond market may not go along. And sure enough, bond yields went up 100 basis points last year. So did they really ease? If the Fed lowers the Fed funds rate by 100 basis points, and that in turn incites the bond vigilantes because they're not convinced it was really necessary, and meanwhile they haven't gotten to their 2% inflation target, well, the bond yield went up, mortgage rates went up. Same thing seems to be happening now. They just cut past 3 months, 50 basis points. Now they're going to do 25 basis points, and the bond market's kind of giving them a warning that they're making a mistake in lowering rates, or at least the bond market's saying, we're going to offset that. So it's kind of absurd to have Fed officials saying we have to lower the Fed funds rate because the Fed funds rate is too restrictive, and then watch the bond yield go up. And so what's the net effect of monetary policy? That's a rhetorical question. Private credit would be another issue. Everybody's aware of the private credit issue. We're watching the private credit ETFs to see if there's any signs that of a real crisis, but that's something to watch. I don't believe that there's something like a 2008 crisis embedded in the private credit market. I think to the extent that things blow up, it reduces the rate of return on a portfolio. It doesn't lead to an economy-wide credit crunch, in my opinion. Another possibility is I could be wrong. The stock market could, for one reason or another, go into a bear market, and then we have a negative wealth effect on the consumer. So that's a consideration. The consumers then would retrench. That would be an issue of what could go wrong. A lot of people are very concerned about the consumer because they're looking at lower income consumers. We're focusing on higher income consumers, or at least we're not focusing on them, but just pointing out that's an important offset and explains why consumers are doing so well. Another area where things could go awry for us is productivity. We're saying that productivity growth is likely to increase up ahead here, that it is already showing signs of doing that. And the naysayers are saying that that we might actually see productivity fizzle. There's an article in Barron's this week that I referred to in the morning briefing. So lots of things to think about. This time I did record it, but I don't know what's going on with my charts, so we're not going to do charts. And I filled in the whole half hour. But why don't I see, there's 3 questions here. Why don't I take them? Cactus, hi Ed, if you are right about this rotation out of Mag 7 to the 493, do you think this happens more likely in an equity market? That is S&P going up or down? Thank you. I think the market will hang in there. I know everybody's been focusing on the concentration issue as a reason to be bearish, that if lo and behold, something terrible happens that makes everybody have second thoughts about the Magnificent Seven, that people will pile out of the stock market and we'll get a bear market. I think you just get rebalancing, and I think the market hangs in there pretty well. I think it's actually been doing that for the past couple of weeks as the issues have been raised about the earnings quality and the competitive situation among the Magnificent Seven. Eric, what is the market impact of the big jump in long-term Japanese yields? Is there a risk to Japanese capital repatriation if the yen can finally strengthen and BOJ more meaningfully tightens? How old is Max? That's a good question. I think Max is about 10. Oh, and he left us. Okay. Sometimes he goes down there, but he's not there. Yeah, Eric, I don't know, but I'm watching it. I think wasn't it a few months ago, maybe it's even a year ago, that we kind of had a stress test of the carry trade, and nothing terrible happened. I think we had kind of a one-day kind of sell-off in the market that the carry trade was about to unwind. So I think we've already kind of given a warning signal to people who are playing the carry trade that it's a dangerous game. But these people know it. They're not amateurs. And so I don't know that what happens in Tokyo doesn't stay in Tokyo. I think it does. I don't think this is if Japan has a debt crisis, that we'll see that have tremendous repercussions around the world, recognizing, of course, the Japanese are big investors in the U.S. and other parts of the world. But these global capital markets are huge, and I think if there is a carry trade issue, it probably will be. I don't think it's going to have widespread repercussions. But I'll do some more work on that, write some more about it. We have in the past, and we'll do it again. Do you expect general affordability, assuming to be addressed by current administration, specifically housing, to improve in the next 2 to 3 years, or current prices, the new baseline? No, I don't know how you fix affordability in 2 to 3 years. We do have a definite problem in the housing market, and a lot of it is political. People don't want cheap housing in their backyard, NIMBYs, so-called. There's a lot of politics involved in all of this. There's a lot of environmental regulations, so that's a whole other political issue out there. So housing affordability remains kind of one of the basic problems, because the not so-called, but the American dream of owning a home is much tougher these days than it was 10, 20, 30 years ago. And we're really not talking about deflation as far as I can tell. I think a lot of Americans, when you think about affordabilities, that they want to see prices come right back down. That's not going to happen, because a lot of Americans don't seem to have wage illusion. They don't realize that their wages have gone up to basically push those to keep those prices up. The affordability problem doesn't look all that bad from a macroeconomic standpoint, but of course macroeconomics doesn't get down to the nitty-gritty. If you take average hourly earnings and divide it by the consumption deflator, real wages have actually been increasing. The problem with that analysis is that it's average hourly earnings. So you've got a lot of people below the average that haven't seen their wages keep pace with prices. So it's a very complicated issue. I don't think it's something that policy can solve readily, but it is something that's worthwhile addressing for sure, because it is all about the standard of living and creating a society where people feel like they have a shot at the American dream. I'll take two more here. Ed, your chart did show when you started charts. Not okay, Jim. But I wasn't okay. I'll look at it for next time. Yeah, I got to do this. Collect on healthcare insurers are fraught. Are you more focused on pharma and biotech? Yes, more pharma and biotech, especially with AI helping those companies. Brian, which of the stated risks do you feel is the greatest? I'd say the bond vigilantes is a concern. And finally, Nick, if an investor if an investor stays invested in the Mag 7, what is the downside, decline, or just subpar returns would be my view. I don't think you're going to lose money, but that's uh, that's my opinion right now. We'll see how things unfold. It can be 2026 could be a really interesting year. I'm thinking of writing another piece. Will 2026 be the year of the bond vigilantes? I'm sure the bond vigilantes will come up as an issue somewhere along the year, but it's been one heck of a ride so far. Stock market's made everybody that's in the market a lot of money, and I still hold to another year of double-digit gains next year, 7,700 for the S&P by the end of next year, and still shooting for 10,000 by the end of the decade. And there'll be lots to talk about along the way. And I thank you for tuning in, for listening to my chatter, and I hope helps you in your thinking about how to invest in these interesting markets. Thank you all.